Welcome to Jitasa University, where our goal is to empower nonprofits through free educational content. These short videos are all provided by trusted partners within our network as well, so each topic will be relevant to every organization, regardless of size. Let's dive right in. This month, we're featuring Kenny Matthews from Landing Rock, a high-yield cash management platform designed to provide expanded FDIC coverage and reduce risk for your organization's idle cash. Let's pass things over to Kenny and get started with the content.
Okay, well, I'm excited today to be talking about the very exciting topic of nonprofit reserves, which I'm sure is extremely interesting to only a small amount of people. But to me, it's very interesting and it's actually very important for nonprofits, no matter which part of the organization you happen to be a part of. Nonprofit reserves is something important. So today we're going to talk a lot about nonprofit reserves, the landscape of 2026, what we can kind of expect and anticipate, why reserves are important, how much in reserves should a typical nonprofit have, and maybe some concrete steps of what to do to kind of make your reserves a little bit more robust, and that you're being strategic around reserves rather than just having it sit there as some idle cash. So jumping right in here, what are we looking at? What's the current landscape for nonprofit reserves? It's no secret that the current situation for nonprofits is a little, let's just say, maybe a little more rough than it has been in years in the past. Though we're seeing some trends in the right direction. Nonetheless, right now we're seeing some reduction in some grant availability, some slower donation cycles, some government instability in terms of foundation funding. Operational costs are also on the rise. And then, post-pandemic donor fatigue is off, played a part in this as well. Not to focus too much on the negative, but the reality of the situation is that gathering and retaining donations is a little bit more difficult than it may have been in the past. Which is to say, highlight why reserves matter so much in these uncertain times when funding might not be as reliable as it has in the past. It's really important that there's a buffer in place for the nonprofit to be able to hedge through kind of these uncertain times. So, why are reserves important? Why do reserves matter? Stability, as I mentioned. It helps you be making the right decisions, not necessarily making decisions because you're backed into a corner, but be able to know that you have some reserves in place that you can make strategic decisions that's best for the organization, not out of necessity per se. And it's really demonstrating fiscal responsibility for your boards and the donors. Nonprofits are obviously trust for donors, and the board is very important. And being fiscally responsible over the funds you're in charge of is a big part of that as well. Okay, so how much should a nonprofit have in reserves? A general rule of thumb is you want to have at least 3 to 6 months of operating expenses in reserves. Now, every nonprofit's a little bit different based on what they're doing and how they're spending their funds. But really, 3 to 6 months in most cases is going to be on the low end, on the minimum side of what you should keep in reserves. So, as you're looking at your nonprofit or nonprofits that you're a part of or have a relationship with, it's good to take a look at the reserves and see how much they have in there, because this is a reflection of what we just went over of why reserves are important. It can give you insight on how fiscally responsible said nonprofit is, and maybe if you are in charge of the nonprofit reserves, you should take a look and make sure that you have that minimum buffer in there, for obvious reasons that you might need it, but also to build that trust with both donors and the board as well. Here's a quick reserve sufficiency checklist. Um, is your revenue predictable? Or are your donations predictable? Is your program, is there some volatility in the space that you're operating in? Is it somewhat cyclical on what you can expect in terms of revenue or donations? And then obviously the fixed versus variable cost ratio based on your expenditures and then also the revenue as well. Is it fluctuating um, on a cyclical basis? Is there variance there? This is all going to play into how much you guys should keep in reserves to make sure that you can weather the storm as different unforeseen events take place. So some of these common pitfalls that we often see nonprofits fall into, keeping all the cash in one place. Now, banks are not likely to close, right? We don't see it very often, but it's not unprecedented. So if you're familiar with FDIC insurance or NCUA insurance, this is federal insurance that the government is guaranteeing up to $250,000 at any given institution. Now, most nonprofits, depending on the size, can very easily have more than $250,000 in annual revenue and also in reserves. Where are you keeping those funds? Is it all in one bank? Say you have $1 million in reserves. Well, FDIC insurance only covers up to 250K at one institution. This is something that's important to be cognizant of and making sure that you are being fiscally responsible in spreading out those deposits to make sure that's all federally insured. So something to be aware of and take a look at. Now, the big question is how much of your reserves are earning interest and how much interest are they earning? Um, we typically see about 40% of nonprofits are earning less than 0.5% on their reserves. That's quite low. To give you an idea, right now, a competitive interest rate should be somewhere around 3% on liquid funds, and it can go up from there as well. So if you're earning less than 0.5%, that's extremely low, but it's not uncommon. If you have the money at a money center bank, then it's what they're paying out on their money market accounts, their savings accounts, their liquid funds is quite low. So take a look at that. It's important to know that you should be earning funds on that. You spend a lot of time and effort in collecting donations and generating revenue for your nonprofit. So it's extremely important that you're not leaving money, in this case, interest on the table when you should there's a lot of optionality out there for you to earn additional interest on that reserve fund. So it's not just sitting as idle cash. The investment insurance, where are you putting these reserves? Are they in savings accounts, money market accounts, T-bills? There's a lot of optionality out there, and it's important to know what the risk profile is for each of these options, and also the liquidity options. How accessible are they to you? And then being strategic around that, making sure that these aren't just idle funds, but these funds are working for your nonprofit, and you're not just leaving money on the table. So, three pillars when considering your nonprofit reserves: safety, make sure it's 100% FDIC insured or in a very, very extremely low risk, federally backed investment product if you go in that direction. Liquidity, you want to be able to access these funds. You don't want them to tie up in certain terms or durations where if you need that cash, you can't get to it. So you want to make sure that it's liquid, that you always have access to that cash. So you don't want to put it anywhere that is going to be difficult to call on and pull if necessary. And then yield, you want to make sure you're earning money on that, excuse me, you're earning interest on your reserve funds to make sure that it's not just sitting there, in turn losing opportunity money by just letting it sit there idly without earning a competitive interest rate. So some options to consider, and here's kind of a breakdown of what you can expect from each. Checking and savings accounts, typically it's FDIC insured or federally insured up to $250,000. But you're going to get, depending on the bank or credit union, you're going to be earning, 10 basis points or 0.1% up to maybe 0.5% on yield is very, very common. Money market accounts are going to be slightly more competitive. Most banks or credit unions are offering this. Again, it's usually FDIC insured up to $250,000 because the money's sitting at one institution, and the yield's going to be between 1% to 2%, sometimes lower, sometimes a little bit higher, just depending on the institution where that money is sitting. Uh, Treasury funds, T-bills. Now, this is government backed, so it's pretty safe and secure, and the yield is going to be quite high as well. Currently, 5% is definitely on the high end of this. Right now, you can expect closer to 4% with the latest federal adjustment on T-bills. And now, one thing to keep in mind is T-bills are accessible typically through brokerage accounts, and that adds a level of complexity to and maybe some sophistication on being able to set those up and manage those. And so there might be just a couple barriers or a couple levels to setting those kind of accounts up, unlike a money market or savings account, which you would find at any bank or credit union. And then there's some insured deposit networks where they have higher FDIC insurance, and then they're going to have the liquidity. This is something that we offer, where you kind of get a little bit best of both worlds. So let's just give you a little bit of idea of what this could look like. A small case study here. Let's say you have 5 million in nonprofit reserves, earning uh, 0.3%, so about a third of a percent versus 3%, which would be a good competitive interest rate right now. You'd be losing about $135,000 of lost interest per year by just not putting these funds into a place that's earning a competitive interest rate that's accessible to you right now. That's equivalent to 2 to 3 program positions, obviously depending on the position and salary and whatnot. But it has real cost and real impact to your organization. Or how big is your typical donor campaign? $135,000 seems like a decent raise for a $5 million reserve fund, and you're just leaving that money on the table, which could save you money, or time and effort for those donor campaigns. Just a real quick plug-in for Landing Rock and what we do. So we're a financial institution, and we offer insured deposit accounts. So we offer FDIC, NCUA insurance all the way to $50 million per tax ID. So that's well above that 250K. And we're just spreading those deposits across our banking network on the back end. So we're able to get high interest rate, a very high competitive interest rate, and also higher FDIC, NCUA insurance, that federal insurance, all the way to 50 million. So if you have more than 250K, you park at a Landing Rock, and you'll be able to get that all federally insured. Currently, our yield is 3%. It is variable, so it can move with the Fed fund, but this is where we're currently at. So it's a very competitive interest rate currently. It's liquid, no fees, no penalties. We worked specifically with nonprofits. That's why I'm presenting here today. Our accounts are extremely conducive for nonprofit reserve funds. So, not to be too salesy here, but just to put a plug in for our accounts as well. Now, you can find ICS insured cash sweeps at most banks and credit unions. We just offer both liquidity and higher federal insurance, and a high competitive interest rate. So, trying to offer a little bit of best of both worlds across the board. So, just a little plug for us, and that wraps up my presentation here. So, I'll turn the time back over to Alex.
Cool. Yeah, thanks, Kenny. Appreciate all the great information in there. Just a couple questions that came up throughout that. One here was, how can executive directors communicate to their board and donors that reserves are not really idle funds, but they're more of like strategic capital for their mission and continuity?
Yeah, I mean that's a great question, and I think even framing that the way that question's framed, I think you're already thinking about it the right way. You should really think about your reserve funds like it's fiscally responsible to have reserves and to cover the 3 to 6 months, in case something happens or whatnot. But like in terms of thinking about donors and boards specifically, it's all about trust, right? You want to be able to come to your board and them to feel very confident, as you being an executive director, that not only are you handling the operations well, but you're also being extremely fiscally responsible by taking that idle funds and maximizing the interest rate and earnings on all aspects of the business, so that you're generating revenue, both obviously from the donations, but then also from those idle funds as well. As I've seen executive directors take this back to their boards and also express this to their donors, it increases a level of trust that the executive director is being proactive on considering the nonprofits, but also the donor funds. And like it's a really great way to build trust as long as you're being proactive in that regard.
Gotcha. Okay. Yeah, that makes sense. And then second one here, do you have an example of a nonprofit that used its reserves to get through like a tough time recently?
Yeah. One comes to mind. I won't name any specific names, but there's a nonprofit that we've worked with in the past, and they raise funds for humanitarian trips on an annual basis, and they take quite the trips themselves are quite expensive, and it's as you can imagine, there's a lot of planning that goes into it, and they're not just taking donations in and then spending it right away. They're having to plan months out in advance. And since they're going out of country, there can be a lot of variance in obviously the expenses. It's hard to plan 3 to 6 months out when you're taking international trips. A lot of things can change. So before they were utilizing Landing Rock, they were just had the money parked at a money center bank, in this case Chase, and it was earning about 10 basis points on their millions and millions of dollars that they were raising. And when they started utilizing Landing Rock, our insured cash deposit account, where they were earning 3%, it equated to hundreds of thousands of dollars. And in this case, in that year, that ended up offsetting a lot of unforeseen cost related to their trips that they didn't see coming up. So if they had kept the money at the money center bank and kind of left, hundreds of thousands of dollars on the table while they were still raising, they might have put them in a tough spot where either I don't think anything necessarily drastic in their case would have happened, but they may have had to change a lot of their plans and made some last minute adjustments to adjust for not having that same kind of cash flow on hand as they did by utilizing a higher yielding account.
Awesome. Yeah. Sounds great. And then, yeah, I think that was all the questions that came up. But yeah, I just want to thank you, Kenny, for taking the time and hope to have you and Landing Rock on again in the future.
Yeah, I really appreciate the opportunity. Obviously, if anything comes up in the future, I'd love to participate, or if individual questions, feel free to reach out.
Thanks for watching. We hope you learned some valuable information on how to protect and build your financial reserves. If you had a question or would like to chat about Landing Rock services, feel free to reach out using the information provided on the screen. Thanks again, and we will see you next time.